Hi everyone. In this video, I will be discussing International Accounting Standard 16, which deals with property, plant, and equipment. For measurement at initial recognition, property, plant, and equipment should be initially measured at cost, which includes the purchase price, including import duties and taxes, all costs that are directly attributable to bringing the asset to the location and condition necessary for it to perform as intended, and an estimate of the costs of dismantling and removing the asset and restoring the site on which the asset is located. An item of property, plant, and equipment that is acquired in exchange for a non-monetary asset or a combination of monetary and non-monetary assets should be initially measured at fair value. Fair value is defined as the amount for which an asset could be exchanged between knowledgeable, willing parties in an arm's length transaction. Now, for measurement subsequent to initial recognition, please note that this is a substantive area of difference between Ifrs and US GAAP. IAS 16 allows two treatments for reporting fixed assets on the balance sheet subsequent to their acquisition: the cost model and the revaluation model. Under the cost model, an item of property, plant, and equipment is carried on the balance sheet at cost, less accumulated depreciation, and any accumulated impairment losses. So this model is consistent with US GAAP. Under the revaluation model, a property, plant, and equipment asset is reported on a revalued basis, which is its fair value at the date of revaluation minus subsequent depreciation and impairment. If a company follows the revaluation model, the revaluations must be made often enough that the carrying amount of the assets does not differ materially from the asset's fair value. If an asset is revalued, the entire class of assets to which that asset belongs is also revalued. If a revaluation results in an increase in the carrying value of the asset, the gain is credited directly to revaluation surplus in the other comprehensive income component of equity. However, if the increase represents the reversal of a revaluation decrease of the same asset which was previously recognized in net income as an expense, then the gain is recognized in net income. Any excess gain, in other words, upward revaluation, is then credited to other comprehensive income in equity. If the revaluation results in a decrease in the asset's carrying value, the loss is first used to offset any balance in the revaluation surplus account associated with the asset, with the remaining loss being recognized in net income as an expense. When the revalued asset is disposed of, any revaluation surplus is either transferred directly to retained earnings or left in the revaluation surplus. Revalued assets may be presented either at a gross amount less a separately reported accumulated depreciation, both revalued, or a net amount. Once a company has opted for the revaluation model, it has an obligation to keep the valuations up to date. While the International Accounting Standards Board does not require annual revaluations, these may be necessary in some instances to comply with IAS 16. All assets of the same class must be revalued at the same time. Selectivity within a class is not permitted, but selection of a class is. Detailed disclosures are required for each class of property, plant, and equipment, whether revalued or not. When a class of property, plant, and equipment is revalued, IAS 16 provides for two alternative treatments for reporting accumulated depreciation. The first one is the proportional method. In the proportional method, the company restates the accumulated depreciation proportionally with the change in the gross carrying amount of the asset, so that the carrying amount of the asset after revaluation equals its revalued amount. So let's suppose that a company has an asset with an original cost of $200,000 and accumulated depreciation of $60,000. The book value of the asset is therefore $140,000. Further, suppose that in a subsequent period, the fair value has increased by 50% to $210,000. Then the restatement would be as follows. On the left, you see the original values of the asset before the revaluation. So the original cost of the asset is $200,000 and the book value is $140,000. In this fact pattern, we are told that the fair value of the asset has increased by 50%. So from the net carrying amount of book value of $140,000, fair value is increased by 50% to $210,000. Okay, so the new carrying values are figured out on a proportional basis. So it's important to keep in mind what the original ratio of net carrying amount to gross carrying amount was. That ratio was $140,000 divided by $200,000, equaling 70%. To obtain the new gross carrying value of the asset after evaluation, you can take the fair value of $210,000 and divide it by that ratio of 70% to obtain a new gross carrying amount of $300,000. And then the difference between the new gross carrying amount of $300,000 and the fair value of $210,000 is the new grossed up accumulated depreciation of $90,000, which is increased proportionally along with the other carrying value amounts. Another way to tackle the problem is to notice that the carrying amount goes from $140,000 to $210,000, which is a 50% increase, right? Because $210,000 is the new fair value. So then you would increase the accumulated depreciation by 50% as well, or $30,000, to get a new value for accumulated depreciation of $90,000. And then you would do the same thing for the gross carrying amount. You would increase it by 50%, in other words, $100,000, to get the new gross carrying amount of $300,000. The journal entry would involve a debit to the asset account for $100,000, a credit to accumulated depreciation for $30,000, and a credit to revaluation surplus of $70,000. With the gross method, the company eliminates the accumulated depreciation against the gross carrying amount of the asset and then restates the net amount to the revalued amount of the asset. So this method is more straightforward than the proportional method. The journal entries that would be made using the gross method, using the fact pattern described previously, are, firstly, a debit to accumulated depreciation of $60,000 because we're eliminating the accumulated depreciation. And then there would be a corresponding credit to the asset account of $60,000, followed by a debit to the asset account for $70,000 and a corresponding credit to revaluation surplus for $70,000. The revaluation surplus in equity may be transferred to retained earnings when the surplus is realized. Realization occurs through the use of the asset or through its sale or disposal. So, the revaluation surplus in equity may be transferred to retained earnings in one of two ways. A lump sum may be transferred at the time that the asset is sold or scrapped, or within each period, an amount equal to the difference between depreciation on the revalued amount and depreciation on the historical cost of the asset may be transferred to retained earnings. Component depreciation is a practice in Ifrs which is not common in US GAAP. What is component depreciation? Well, if an item of property, plant, and equipment consists of significant parts for which different depreciation methods or useful lives are appropriate, each part must be depreciated separately. So components can be physical, such as a blast furnace, or non-physical, such as an annual inspection. And as I mentioned, component depreciation is not commonly used under United States GAAP. So this is the end of discussion on IAS 16 property, plant, and equipment. So if you haven't done so already, I would encourage you to go ahead and start taking a look at the homework problems.